Hello traders, you are welcome back to the Forex Geek channel. In this video, we are diving into the best 5-minute gold strategy. It's a simple but powerful approach for trading gold on short time frames. So if you're looking for a structured way to scalp gold while managing risk, stay tuned because we are breaking down this strategy step by step. Now, gold is one of the most volatile assets in the Forex market, which makes it ideal for short-term trading. The 5-minute chart offers a balance between quick trade opportunities and manageable market noise, making it a preferred time frame for many traders. So to trade gold effectively on this time frame, we use a combination of indicators, and price action analysis to filter out weak signals and catch high probability trades. All right. So now here's what you need to do to set up the best 5-minute gold strategy. All right. The indicators that we're going to be using are the 200 EMA. All right. We're going to be using the 200 EMA. Okay. We're just going to set this period to 200. All right. This is going to help us to identify the overall trend. Okay. And then we are going to be using the RSI, the relative strength index. We are going to set the period to 14. The default period is already 14. Okay. Default period is already 14. And then we are going to change this, the upper band, we are going to change it to 60, not 70. And then we are going to change the lower band to 40. All right. It helps to confirm momentum shifts. Okay. All right. Now for the chart setup, of course, you open your 5-minute gold chart. Then you apply your 200 EMA, you apply your RSI indicator. You identify whether the market is in an uptrend or a downtrend before taking your trade. So currently, we can see that the market is in a downtrend. Okay, make sure that you identify the prevailing trend in the market. It is very necessary. So once you have identified the prevailing trend in the market, then you can look for an opportunity in the direction of the trend. All right. Now let's look at examples for a buy trade and examples for a sell trade as well. Okay, let's not use this. Let's use more. All right. So for a buy trade, price must be above the 200 EMA. It's compulsory. All right, it's compulsory. Price must be above the 200 EMA for a buy trade. And then once you have confirmed that this is a bullish trend, because the price is above the 200 EMA, once you have confirmed that, you wait for a pullback. For example, you can see that price has been above the 200 EMA. Okay, a crossover happened here. A crossover happened here. The price crossed below the 200 EMA to above the 200 EMA around here, right? So after you have identified this bullish move, you wait for a pullback. You can see a pullback to the moving average. Once the pullback has been verified, then you look out for a confirmation pattern. Okay, for example, we can see this bullish candlestick pattern around here, right? Once you get a confirmation pattern after price gets rejected from the 200 EMA, then you look down and ensure that the RSI is coming out from the oversold territory. Ensure that RSI is coming out from the oversold territory, pushing up above the 40 level. Okay. So once you have confirmed that, this is going to confirm the bullish momentum. All right. Ensure that RSI has dropped into the oversold and climbing out from the oversold territory. Okay, you can enter the trade on a strong bullish candle close, like this particular bullish candle that we found. Just ensure that the bullish candle, ensure that price has closed the candle, sorry, ensure that the candle has closed above the previous candle. Ensure that we have a bullish candlestick pattern, basically. So once that has been confirmed, you can enter your buy trade. You set your stop loss below the previous swing low. All right, below the previous swing low. You set your stop loss below the previous swing low, and then your take profits. You can actually use key resistance zones. Ensure that you have a good risk to reward ratio, at least one ratio, 2 risk to reward ratio. Or when the RSI starts to drop below the 60 level, then you can use that to exit, can use that to exit your buy trade. Okay, can use that to exit your buy trade. Now for a sell trade, price must be below the 200 EMA. Okay, for a sell, price must be below the 200 EMA. Ensure that you have a sell trend. Remember that this strategy is for a trending market. This strategy is for a trending market. It is not for a ranging market. Okay, so here we can see that we already had, first top, another lower high, another lower high. So we already notice that this is a sell trend at the moment. All right, so you wait for the price to be below the 200 EMA. Can you see? This is where the price dropped below the 200 EMA. After that, you wait for a pullback. So you can see that this pullback, this was where the price dropped below the 200 EMA, remember? And then after that, you wait for a pullback to the 200 EMA again. So after that pullback has happened, then you look for a continuation pattern. Ensure that there is a continuation back to the downside. For example, we can see that we had a bearish pattern around here alongside the doji. All right, so you also look out for the RSI. Ensure that the RSI is dropping below the 60 level. The RSI, it might not necessarily be in the overbought, but at least close to the 60 level and coming down. You can see now it's coming down, coming down from the 60, from the overbought territory or close to the overbought territory. So once you have your confirmation, you can enter your trade. All right, once you have a strong bearish candle close, you can enter your sell, set your stop loss above the previous swing high, and then your take profits can be around support zones. Just ensure that you have a good risk to reward ratio. All right, your take profits can be around key support zones. Key support zones, you can use key support zones for the take profit level. If you have a good risk to reward ratio, you can go ahead and enter the trade. But if you do not have a good risk to reward ratio, please just stay out of the trade. Okay, remember that not every signal is valid. So here's how to avoid low quality trades. 1, avoid trading during major news events because gold reacts heavily to news. So check the economic calendar. Also, ensure that all indicators align before entering a trade. Avoid trading in sideways or choppy markets. Look for strong trends. Risk management is crucial when trading gold due to its volatility. So here's how to stay safe. Never risk more than 1 to 2% of your trading account per trade. And always use a stop loss, all right, to protect against unexpected moves. Stick to the strategy. Do not chase trades or overtrade. Okay, so that is the best 5-minute gold strategy explained in detail. If you enjoyed this breakdown, hit the like button, subscribe to the channel, and turn on notifications so you don't miss any upcoming strategies. Drop a comment below. Do you trade gold on lower time frames or do you prefer longer setups? Let us start a discussion. See you in the next video and happy trading.